Welcome to the December installment of Asking for a Friend. This is a monthly webinar series where we answer your questions on a wide variety of topics, ranging from capital markets to financial planning tips and techniques. I'm your host, Eric Jefferson with TrestleBridge Capital. And in this installment, we're going to explore what historically drives stock prices as we attempt to forecast what could take place throughout the course of 2023. To kick things off here, we have a few quick words from our legal team. With that, we can dive right in. Unlike a commodity, a used car or baseball cards, the price a buyer's willing to pay typically is what they can sell it for, less their cost of doing business. When you think about stocks, which are capital assets that generate cash flow, that formula tends to be a little more complex. But historically, there are two key inputs that dictate the price of a stock. One are earnings or expected future earnings. What does a company generate in revenue? And secondly, what multiple investors are willing to pay for the right to own those underlying earnings. So to give some context here, when we talk about earnings, that's more commonly referred to as profit. Profit is revenue or the value of all goods and services sold minus the cost to run the business and generate that revenue. That cost includes things like wages to pay employees, taxes, interest on any debt, as well as other expenses. Typically speaking, during good times, you see CEOs and a company's strategy look to grow their earnings by increasing revenue, finding new ventures, opening new facilities, expanding into different markets. And during the bad times, more emphasis is placed on trying to protect and preserve existing earnings. Oftentimes, that takes the form of cost cutting. Unfortunately, we likely hear layoffs going into or during a recession. That is a form of cutting costs. And longer term, if we go back over the last 30 years, we can see earnings and the price of the S&P 500 are highly correlated. We have the S&P 500 price level in purple there. The orange line represents the earnings the S&P 500 companies collectively generate in a given year. And again, we can see long time or over time, as both ebb and flow, they tend to generally move in the same direction. They have roughly a 80% correlation. However, what explains for the other 20% is a function of what investors are willing to pay for those earnings. That is commonly referred to in the investment universe as the price to earnings ratio. This will fluctuate over time depending upon the market environment. Historically, during recessionary times and bear markets, PE ratios will dip to the low end of 15 times earnings. They can increase significantly. We saw the end of last year earnings around 40 times. When we think about what drives different PE ratios over the course of different market and business cycles, one, typically a function of interest rates. The lower the interest rates, the higher price to earnings multiple investors are willing to pay. As well, investor sentiment. The more confident you are in the future ahead, typically speaking, the more you're willing to pay for an investment, again, with the expectation that that will continue to appreciate in value. Similar to the earnings, when we go back, look how the two are correlated over time. Again, we have the purple line there. That represents the price level of the S&P 500. And in orange here, we have the annual price to earnings ratio for the S&P 500. Similar to that earnings graph, again, not a perfect one-to-one relationship, but certainly there is a high correlation. Again, that is a function of PEs adjusting over the market cycle. A combination of PEs and the underlying earnings, in essence, are a very valid forecasting tool when we think about what describes what ultimately dictates price movement for the S&P. Now, as we look to the road ahead, I think it's fair to assume in our base case, a PE ratio of 17 times. That is slightly below the long-term average, but I think is very appropriate given the market environment today. Still a lot of unknowns around what happens in Ukraine, around interest rates, around the reopening of China. And earnings for 2022 likely come in at $225. We think that's a fair estimate looking to the year ahead. Again, where we're not going to have booming macro growth, that eliminates or reduces somewhat of a natural tailwind. We think companies will work to find ways to continue to maintain those profit levels, and thinking a 225 is a fair earnings estimate, doing some basic arithmetic, that would get us to a year-end price target for the S&P 500 of 38.25, trading very similar to where we are today. If things wind up being better than expected, we have some meaningful progress on inflation. We have a peaceful resolution in Ukraine. We see China reopen and the second largest global economy in essence come back online. We think that's an environment that could certainly justify a higher PE ratio. Let's say we forecasted 20 times, and in that environment, we saw earnings increase an extra $10 to $235. Some arithmetic there would get us to a year-end S&P 500 price target of 4,700. That obviously represents a fairly substantial increase from current levels today. And then vice versa, if things go worse than expected, inflation proves to be stickier than anticipated, interest rates continue to march higher in order to try and get that under control. Typically, during a recession, during a bear market, we can see PE ratios dip down to 15 times. In that example, if earnings also took a $20 hit, 15 times 205 gets you to a price target just shy of 3,100. Obviously, that would represent some downside based on where we are currently trading today. So hopefully this is helpful when we think about how do we understand, how do we try and forecast what goes into determining future price movements for broad indices. As always, we stand ready to answer any questions. Encourage you to please send them in. Best resource, eric.jefferson@trestlebridgecapital.com. Love to get those questions in, feature them in a future segment. That's all for now. As always, happy to discuss anything in more detail. If you don't connect, have a great holiday. Take care.